In a year where Nifty basically took a nap, this sector kept jogging like it had somebody to impress. And at a time when the Nifty is down by 3% from its all-time high, this bunch is off by only 1.9%. Steel has stamina, and it's outperformed Nifty over the last year. No drama, just pure gains. Yep, so steel stocks. Nifty Metal delivered around 5.5% in the past 12 months. And in the last 3 months, it's been the second best performing sectoral index, quietly flexing. Metal, better than mood swings. Meanwhile, you have brokerages like CLSA that have raised EBITDA estimates for metals and mining from -4% to +8% for FY26 to FY28. So today, 3 metal stocks and why they're moving. Simple story with big signals for us. 3 picks, 1 theme. Okay, this index is dominated by iron and steel. So we're going to be sticking to the heavyweights out here. We've picked 3 top performers over the last 3 months. So that's JSW Steel, Jindal Steel, and Jindal Stainless. Together, these 3, they hold about 19.5% of India's steel market. Serious share, and they've got serious plans. The big 3 have big bite. What's moving them? Let's start with what we should discuss given today's time, the global tug of war. India is the world's second largest steel producer, and that's no small feat. Our production growth is outrunning developed markets, but prices still sneeze when China catches a cold. China, they set the tone. In 2024, China's steel use fell by roughly around 5%, and the demand has been shrinking for a few years now. So they exported more, around 111 million tons, and it's the most since 2016. They're essentially flooding global markets. The net exports have climbed over the years, and this is pressurizing realizations, and that's what producers actually earn per ton. The price gets punched first, and as a result, the global export party got rained out, and producers pivoted to domestic markets to kind of survive. But China's oversupply still leaks into India. JSW, for example, they saw slower sales growth despite having higher volumes because lower prices and imports bit into that revenue. And steel prices have been under pressure for a while. Volume up, revenue, not so much. So yes, the biggest headache for Indian steel has been China. But here's where the plot starts twisting. China is planning to curb overproduction. Action plan, strict ban on fresh capacity, the whole works. And why? Overcapacity with negative margins. You have listed Chinese steel companies averaging around -0.26% profit margins despite producing over half of the world's steel. CLSA is saying China could cut 50 million tons in 2025. Big swing if it actually sticks. And a cut like that will help India by easing the global price drag and letting our domestic prices also breathe. So, supply cut, price lift. You add India's 12% duty on certain steel products from April 2025 this year, imports reportedly dropped by 40% already. So what started off as a 200-day safeguard may extend to 3 years if the Trade Department's suggestions actually goes through. So that wraps up the China angle. Now to the tailwinds at home and abroad. Macro is turning friendlier. So the US Fed trimmed rates by 25 bips. It's cheaper money, and it typically helps cyclical sectors like metals. Back home, we've got our GST slab tweaks, and post-monsoon project restarts also nudge demand from housing, autos, infra, usually within weeks. Projects back on site. About 2/3 of India's steel goes into construction and infra. So even normal seasonality can move that needle. Coking coal, and this is the coal that goes into actually making steel, that cooled from about $260 per ton to about $193, $207 per ton last quarter. And this was a welcome relief for the costs. India also diversified coking coal sourcing, moving beyond Australia to the US and Russia. Newer suppliers mean better prices. Russian coking coal imports, they tripled from FY22 to FY24, and this was helped by the discounts post those sanctions. Now the iron ore costs, they eased as well, around 4.1% decline in FY25 thanks to more regional sourcing. For instance, we've got JSW that reported a 1% drop in materials expense with coking coal savings of about 500 rupees per ton. Cost cuts boost margins. Next up, expansion mode. India's steel makers are scaling with clear timelines and big capex. We've got JSW Steel that's planning to lift capacity from 35.7 metric tons per annum, that's MTPA, to 51.5 MTPA by FY 2030-31, driven by Vijayanagar and Dolvi. We've got Jindal Steel and Power, and they're doubling Angul output from 6 to 12 MTPA by FY 2026, and they're aiming for 15.6 MTPA total by FY 2027. Plus, they've also got a Maharashtra greenfield kicking off with 1 MTPA by FY 29-30. Jindal Stainless is also looking to move from 3 to 4.2 MTPA by FY 27, including a 1.2 MTPA Indonesia JV kicking in and a long-term 4 MTPA Maharashtra plan over 10 to 15 years. That is serious steel-on-steel execution. You build now, you benefit later. Time for the financials. What's that scoreboard saying? Now, over the last 6 quarters, we're talking from March last year 2024 to June 2025 now, JSW's YOY sales, they swung down in the late 2024, but they mildly recovered. Jindal Steel, they peaked mid last year and they slipped into negative growth through this year. Jindal Stainless rebounded from late 2024 and they have held momentum into this year. Now, despite this revenue softness, you've got operating profit margins that have risen across the board as raw material costs kind of eased. So the margins, they did the heavy lifting here. Zooming in into the latest quarter, we've got Jindal Steel and Power. Their revenue is down about 10% to over 12,290 crore rupees. Their operating profit is up by about 6% to over 3,000 crore rupees. Margins at 24% on lower coking coal and richer product mix. So the net profit is 1,496 crores. It's up by about 12% YOY. Now Jindal Stainless, revenues up 8% to about 10,200 crore rupees. Operating profit up 7% to a little under 1,300 crore rupees. Margins are steady at 13%. The net profit is 715 crores, it's up by about 11%, and that's also aided by a better mix and import curbs on the low-grade stuff. JSW Steel, revenues flat at almost 43,150 crore rupees. The operating profit is up 36% to over 7,470 crores. Margins are at 17% on higher prices, and there's a record 64% value-added mix and a $14 per ton lower coking coal. So the net profit is over 2,200 crores, and that's about up by 2.5 times. Flat sales, fatter profits. Balance sheets though, they tell you the capex story. Now JSW Steel's assets, they rose from about 1.96 lakh crores in 2022 to about 2.4 lakh crores in 2025, with borrowings up from 72,000 crore rupees to about 99,000 crore rupees. And this growth has been funded by more debt, but this is aligned with their expansion plans. Jindal Steel's assets dipped in 2023 to about 69,000 crore versus the 76,000 crores in 2022, and they kind of recovered to about 85,800 crore in 2025. Their borrowings climbed. It moved from 13,500 crores to about 18,400 crores. Again, there's some selective reinvestment here, but not reckless leverage. It's heavier, but also healthier. Jindal Stainless, they have scaled steadily. Assets have gone up from about 22,600 crores in 2022 to about 35,900 crores in 2025. Borrowings from about 4,000 crores to about 6,400 crores, and it's relatively staying light on leverage versus their peers. Looking ahead though, Jindal Stainless targets 9 to 10% sales growth with 19,000 to 21,000 EBITDA per ton this year. JSW is guiding about 10% volume growth in FY26, but they're staying on track for their about 50 MTPA output by FY 2030-31. Jindal Steel, they are eyeing about 8.5 to 9 MT sales in FY26 with about 18 to 20% ROC from their expansions. That is guidance with grit. So, what are the risks out here? Alright, let's talk about that. Now, imports, especially in stainless. You see, nearly 30% of India's FY25 stainless consumption came from imports, including some substandard lots that came from China and flows from ASEAN, like Vietnam. Now, this can cap prices and, well, squeeze local producers as well. So keep that on your dashboard. It kind of matters for margins if the curbs loosen. And that's the picture. So what's the bottom line? While the broader market wobbled, steel quietly kept climbing. China cutting production, India tightening imports, raw material costs easing, and infra housing demand rising up created a sweet, sweet spot. Now add the expansion engines at JSW, Jindal Steel or Jindal Stainless, and it's clear why investors see long runways here, even if Nifty's catching a breath. Steel, well, it's writing its own script. Well, thanks for catching this edition of Bottom Line. The conversation, as always, continues in the comments below, and we look forward to your thoughts. Goodbye for now, and continue staying smart with your investments.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.